Welcome to the Deep Dive. Today, we're focusing on a really critical question for any business, I think. How do you actually make smart decisions about future borrowing costs today? Especially when, the market's constantly shifting. It's really all about navigating that uncertainty in financial markets, particularly borrowing and lending.
Absolutely. And our mission in this deep dive is to, unravel the pretty fascinating world of interest rate forwards. And crucially, how they're applied in interest rate swaps.
Yeah.
We're not just going to define the terms, though. The idea is to really understand how these rates get determined from the spot yield curve.
Yeah.
And why they are such essential tools for valuing, complex things like swaps.
Exactly. Think of this as maybe a shortcut, a way to get a handle on a really vital area of financial management. We're building on what you might already know about bonds, the yield curve, yield to maturity, kind of connecting those dots.
Yeah, to really grasp forwards and swaps, you absolutely have to start with the foundation.
Yeah.
And that's the spot yield curve. In essence, it just shows you the current interest rates for borrowing money right now today for different lengths of time.
Okay, so let's put that into practice. Imagine you're a company, you go to a bank, the bank looks at your risk profile and quotes you specific annual spot rates. Like in the scenario we're looking at today, the figures are 1-year loan, 3.50%, 2-year loan, 4.60%, 3-year, 5.40%, 4 years, 6.10%, and then 5 years is 6.30%.
That's it, exactly. And what that means practically for the company is if they choose, say, that 2-year loan, they're agreeing to pay 4.60% interest per year for both years. These are the immediate costs fixed right now for borrowing over those different time periods.
Okay, that makes sense for borrowing today, but here's where it gets, really interesting for planning, right? What if a company doesn't need the money right now? Maybe they want to borrow for a period starting, say, a year from now, but they want to lock in the interest rate today. Is that even possible? Sounds a bit like predicting the future.
Well, in a financial sense, it sort of is. This is exactly where forward rates come in. A forward rate is an interest rate that's fixed today. But it's for a loan that will actually start at some point in the future. So even though you don't need the cash for another year, you can agree on the rate you'll pay right now.
So how is that actually done? Is it formal?
Oh, very formal. It's usually done through something called a forward rate agreement, an FRA. You might see notation like 12v24 FRA.
Okay, what does that mean? 12v24.
That just means it's an agreement for a loan starting in 12 months' time.
Yeah.
And it lasts for 12 months. Ending 24 months from today. Yep. It's just a precise way to specify that future loan period.
Got it. That clarifies the jargon. Okay, so let's take this a step further. If a company wants to borrow for 3 years, based on our example rates, they could just take the 3-year spot rate, which was 5.4%, right? Pay that each year.
They could. That's the simple option.
But forward rates give them more flexibility, don't they? Different ways to structure it.
Absolutely. Loads of flexibility. Think about it. Option 1, as you said, pay the fixed 5.40% for all 3 years. Straightforward. Option 2, pay 3.50% in year 1. That's the spot rate. Then they could agree today on a forward rate of, say, 5.71% for the second year and another forward rate calculated today of 7.02% for the third year.
Wow.
Or option 3, maybe pay 4.60% for the first 2 years. That's the 2-year spot rate. And then lock in that 7.02% forward rate just for the third year.
So these forward rates, like a 5.71% for year 2 or the 7.02% for year 3, where do those numbers actually come from? Are they just the bank's best guess, or is there some calculation behind them?
That is the absolute key. They aren't arbitrary at all. They are meticulously calculated from the existing spot yield curve. It's based on something called the no arbitrage principle.
No arbitrage.
Yeah, basically, it means there shouldn't be a way to make risk-free money just by borrowing and lending differently. Imagine you want funds for 2 years. You could take the direct 2-year loan at 4.60%, or you could borrow for 1 year at 3.50% and simultaneously lock in a forward rate for year 2. For the market to be stable, the total cost over those 2 years must be the same, whichever path you choose. Okay, so the math has to work out, so neither option is automatically cheaper. Precisely. That mathematical relationship lets us imply or calculate what that forward rate for the second year must be based on the 1-year and 2-year spot rates. It ensures the whole yield curve is internally consistent.
That's a really crucial insight. Okay, so companies aren't guessing. They're using today's market structure, the spot curve, to figure out what future rates are implied to be. And these forward rates then become like building blocks for more complex stuff, like interest rate swaps.
Exactly, they're fundamental.
So let's talk swaps. A classic scenario, right? A company has, say, $100 million in loans, but they're variable rate, repayable in 5 years. They look around, maybe they think rates are going to rise, and they want to fix their payments, manage that risk.
Yeah, that's a textbook case for an interest rate swap. The bank steps in with a solution. The company agrees to pay a fixed rate of interest to the bank. Let's call that the swap rate. In return, the company receives a variable rate payment from the bank.
Okay, paying fixed, receiving variable.
Right, and here's the critical detail in our example.
Yeah.
The variable rate the company receives. It's based on the prevailing market yield rates less 50 basis points. So minus 0.5%.
Ah, okay, that detail matters.
Hugely.
Yeah.
So the company takes those variable payments it receives from the bank and uses them to help pay the interest on their original $100 million variable loan. Effectively, they've swapped their floating payment obligation for a fixed one without messing with the original loan.
That makes a lot of sense as a risk management tool. So for this $100 million loan, how do they actually figure out what that fair fixed rate, the swap rate, should be? What's the principle?
The core principle, and this is fundamental, is that at the very start of the swap, day zero, the net present value, the value today of all the variable payment the company expects to receive, must be exactly equal to the net present value of all the fixed payments the company expects to pay to the bank. It has to be balanced from the get-go. That's how the fair fixed rate is set. No upfront advantage to either side.
Balance from day one. Okay, so to get that balance, we first need to know what those expected variable receipts look like over the 5 years. Can we project those using our spot and forward rates? And remembering that 50 basis point reduction.
We absolutely can. Based on the year one spot rate and those implied forward rates we talked about for years 2, 3, 4, and 5, all knocked down by 0.5% or 50 basis points. The company can project what it expects to receive from the bank each year. So year one, they expect $3.0 million. That's based on the 3.5% spot rate minus 0.5%.
Right, 3% of $100.
It's exactly. Year two, using the implied forward rate minus 0.5%, it comes out to $5.21 million. Year three works out to $6.52 million. Year four, $7.73 million. And in year five, it's $6.60 million. Those are the projected cash flows coming in from the bank over the 5 years.
Okay, so we have those 5 incoming amounts, and you said their present value has to equal the present value of the fixed payments going out. Now, our source material gives us a simplified equation to show this. 24.12 meters, 4.26 R equals 0. Can you break down what the 24.12 meters and the 4.26 R actually represent here?
Yeah, that equation really neatly summarizes the valuation, the 24.12 meters. That is the total present value of all those variable receipts we just listed, the $3, $5.21, etc. Each of those future cash flows is discounted back to today using the appropriate spot or forward rates from our yield curve. Add them all up, you get 24.19 million.
Okay, so that's the PV of the receipts. What about the 4.26 R?
All right, so R is the unknown fixed amount the company pays each year. We need to find R. The 4.26 represents the present value factor for an annuity. It's like asking, what's the value today of receiving $1 each year for 5 years, discounted using our yield curve rates? That value is 4.26. So 4.26R gives you the total present value of paying that fixed amount R each year for 5 years.
Ah, okay. So the equation 24.1 null is 4.26R equals 0. It's just like PV of receipts minus PV of fixed payments equals 0. They're equal.
Exactly. It sets the present values equal to find the balancing payment R.
And if we solve that simple equation for R, we get $5.68 million. So R, the fixed amount paid each year, is $5.68 million. And as a percentage of the $100 million loan principal, that's 5.68%.
So that 5.68% is the fixed swap rate. That's the rate the company will pay the bank each year for the 5 years of this interest rate swap.
Precisely. That 5.68% is the equilibrium point, the swap rate determined at the start of the contract.
Right.
That's a huge piece of info for their planning. But thinking strategically, what does agreeing to pay 5.68% fixed actually mean for the company? Is it purely about dodging rate hikes? Or is predictability itself valuable even if rates ended up falling?
That's a great point. It's often more nuanced than just betting on rates. Yes, hedging against rising rates is often the main driver. But predictability, that's incredibly valuable too. Even if rates happen to fall later, the company now has a known fixed interest expense locked in for 5 years. That simplifies budgeting, forecasting, everything. They've essentially traded the potential upside of lower rates for the certainty of their cost.
And in practice, these payments, the fixed one going out and the variable one coming in, they don't actually exchange the full amounts, do they? They net them off.
That's right. They're typically netted off. Saves hassle and reduces counterparty risk.
Can you give an example using our numbers?
Sure. In year one, remember, the company pays the fixed $5.68 million. They expect to receive the variable $3.8 million. So the net effect is the company makes a payment to the bank of $2.68 million. That's the difference.
Okay.
But look at year three. They still pay the fixed $5.68 million, but they expect to receive $6.52 million variable. So in that year, the net effect is the company actually receives $0.84 million from the bank.
Right. The net flow can go either way depending on the year and the rates.
Exactly. And the key thing remains, if you take the present value of all these net annual cash flows, $2.68 out, 0.24 million ins, etc., over the 5 years, discounting them at the proper rates, the total PV at the start of the contract will be zero. That confirms the initial fairness.
That makes the mechanics really clear. Now, here's something interesting our source mentions. That calculated fixed swap rate, 5.68%, it's actually lower than the 5-year spot rate from the curve, which was 6.30%. Intuitively, you might think they'd be closer, maybe even the same. Why is the swap rate lower?
Yeah, that often surprises people initially, but it makes perfect sense when you think about the yield curve shape. Our example uses an upward sloping yield curve, right? Shorter-term rates, like the 1 year at 3.50%, are lower than longer-term rates, like the 5-year at 6.30%. The swap involves cash flows happening throughout the 5 years, not just at the end. Some of those receipts and payments, especially the earlier ones, are based on or discounted using those lower earlier rates on the curve. This pulls the overall average fixed swap rate down below the final spot rate. It reflects the time value of money across the entire curve, not just the endpoint.
That's a subtle but really important point about how the curve shape directly impacts the swap price, okay? And what happens to the swap's value after day one? It starts at zero value, but it must change, right?
Oh, absolutely. It rarely stays at zero for long. Its value fluctuates constantly based on two main things. First, changes in market interest rates. If overall rates increase after the swap starts, the company paying fixed at 5.68% is now at a better position. They're paying less than the new higher market variable rates, so the swap becomes variable to them.
It gains positive value for the company paying fixed.
Exactly. And conversely, if rates fall below 5.68%, the swap might develop a negative value for them. It becomes a liability because they're stuck paying a higher fixed rate. The second factor is just the passage of time. As the swap gets closer to maturity, there are fewer remaining payments and receipts. So even if rates stay the same, the absolute value of the swap will generally decrease as it approaches its end date.
And we should probably mention, like our source does, that these examples are a bit simplified, right? We're using annual cash flows, simple rates. The real world gets more complex.
Definitely. Real-world swap valuation involves things like more frequent payments, quarterly or semi-annually, different day count conventions, potential options for early termination, credit risk adjustments. It gets much more involved. But the core principles we've discussed using forward rates derive from the spot curve to set an initial zero NPV contract. That foundation remains the same.
It provides a really solid base for understanding, even if the practical application has more layers.
Yeah, what's really neat is seeing how it all connects. You start with a simple spot curve. You use that to derive forward rates, which represent market expectations. And then you use those rates to price and value something as sophisticated and useful as an interest rate swap.
So we've really journeyed quite a distance today, from getting grounded in the spot yield curve, looking ahead with forward rates, all the way to seeing how these concepts are the absolute engine for valuing interest rate swaps.
Yeah, I think this deep dive really highlights how these financial tools, which seem complex on the surface, ultimately allow companies to get a much better handle on their future interest rate exposure. They can turn what feels like guesswork about the future into, well, a calculable and manageable risk.
Okay, so we've unpacked the mechanics, the strategy behind forwards and swaps. Here's something to think about as we wrap up. Now that you've seen how this kind of financial engineering works, locking in future rates, swapping variable for fixed, how might a company's leadership use this power, this ability to manage rate uncertainty, to actually make bolder, perhaps more confident long-term investment decisions, especially when they're staring into what seems like a really unpredictable economic future?